$36 trillion. Say that number out loud. $36 trillion. Most people hear it and their brain simply files it away as a very large number and moves on, because the human mind was not built to process quantities at that scale in any meaningful way. So let me give you a frame that actually communicates what this number means in practice. If the United States government decided tomorrow that it wanted to pay off its national debt entirely, and it committed every single dollar of federal tax revenue toward that goal, no military spending, no Social Security, no Medicare, no salaries for government workers, nothing else, it would take approximately 14 years just to clear the balance at current revenue levels. 14 years of the entire federal government doing absolutely nothing except paying back what it already owes. That is the hole the United States is sitting in right now, and it gets deeper by $3 billion every single day. I want to be very clear about something before I go any further. I am not here to tell you the United States is about to collapse. I am not here to predict a date when the system breaks. What I am here to do is show you what the data says about the relationship between debt at this scale, the monetary decisions that debt forces, and what history tells us about how gold behaves when those conditions come together. Because that relationship is one of the most consistent, most documented, most repeatedly validated patterns in the entire history of monetary economics. And right now, the setup for that pattern is more complete than it has been at any point in the last 50 years. My name is Marcus Vail. I spent over a decade as an analyst inside the financial system before I concluded that the information environment available to ordinary investors is structured in a way that consistently serves the institutions at the center of that system rather than the people sitting outside it. The debt story is the clearest example I know of that dynamic. The numbers are entirely public. Every figure I am going to cite today comes from official government sources: the Congressional Budget Office, the Treasury Department, the Federal Reserve itself. None of this is hidden. All of it is ignored by the mainstream financial press in the way that only information which is genuinely inconvenient gets ignored. So let us start with what the debt actually means for the Federal Reserve, because that transmission mechanism from debt to monetary policy to gold is the core of what I want to walk you through today. When a government borrows money, it pays interest on that borrowing. For most of the period between 2009 and 2022, the United States was able to carry an enormous and growing debt load at relatively low cost because interest rates were historically suppressed. The Federal Reserve held its benchmark rate near zero for years at a time. The government could roll over maturing debt and issue new debt at rates that, while not free, were manageable relative to the size of the economy. That dynamic changed in 2022 when the Fed began the most aggressive rate hiking cycle in 4 decades in response to inflation that it had spent the better part of a year insisting was transitory. Rates went from near zero to above 5% in roughly 18 months, and the consequence of that shift, applied to $36 trillion of outstanding debt, is a number that should make every serious observer of fiscal policy deeply uncomfortable. The Congressional Budget Office now projects that net interest payments on the federal debt will exceed $1 trillion annually. $1 trillion per year, just in interest, not principal repayment, not new spending, just the cost of carrying the existing debt at current rates. That figure exceeds the entire defense budget. It exceeds Medicare spending. It is, by any reasonable historical standard, a fiscal condition with no peacetime precedent in American history. And here is the part that creates the trap from which there is no clean exit. The government cannot simply stop spending to close this gap because a significant portion of spending, Social Security, Medicare, debt service itself, is legally mandated and politically untouchable. It cannot raise taxes enough to matter without triggering an economic contraction that would reduce revenue and worsen the fiscal position, and it cannot allow the Fed to keep rates high indefinitely because the refinancing cost of rolling over maturing debt at elevated rates compounds the problem every single quarter, which leaves one option that governments throughout history have consistently reached for when the arithmetic of their fiscal situation became impossible to resolve through any other means. They have their central bank purchase the debt by creating new money. They print. They inflate. They dilute the existing stock of currency in circulation by expanding it, which transfers purchasing power from the holders of that currency to the government that issued it. It is, in economic terms, a tax that never gets voted on and never appears on anyone's tax return. It is also, in historical terms, the single most reliable precursor to a major repricing of gold that exists in the entire monetary record. Let me give you the historical evidence for that claim because I want this to be about data rather than assertion. When the United States left the gold standard entirely in 1971 and the government began funding its expanding obligations through monetary expansion, gold was trading at $35 an ounce, the fixed convertibility price that had been maintained since Bretton Woods in 1944. By 1980, gold had reached $850 an ounce. That is a move of more than 2,300% in under a decade, driven almost entirely by the loss of monetary discipline that the gold standard had previously enforced. The people who understood what Nixon's decision meant in monetary terms, who followed the debt trajectory, who watched the money supply expansion, who recognized that the dollar's purchasing power was being systematically eroded, participated in one of the most significant wealth preservation events of the 20th century. The people who trusted the official reassurances that the system was sound and that inflation was under control watched the purchasing power of their savings cut to a fraction of what it had been. Move to the 2000s. The U.S. government responded to the September 11 attacks and then to the 2003 invasion of Iraq with a combination of tax cuts and massive spending increases that sent the deficit into structural territory. The Fed kept rates low to support the economy. Gold, which had been largely dormant through the 1990s, began a 10-year bull market in 2001 that took it from under $300 an ounce to over $1,900 by September 2011. Again, the pattern was the same. Debt expanded, monetary policy accommodated, currency purchasing power came under pressure. Gold repriced to reflect the new reality of what a dollar was actually worth in terms of real purchasing power. Then 2008. The financial crisis triggered the largest peacetime monetary expansion in American history up to that point. The Federal Reserve's balance sheet went from under $1 trillion to over $4 trillion through successive rounds of quantitative easing. Gold went from roughly $750 at the depths of the crisis to over $1,900 3 years later. The data does not suggest that this pattern is coincidental. It suggests that it is structural, that the relationship between debt-driven monetary expansion and gold appreciation is one of the most robust and repeatable dynamics in all of financial history. And now consider where we are today. The Fed's balance sheet, even after the partial reduction of the last 2 years, remains at approximately $7 trillion, nearly double its pre-pandemic level and more than 7 times its pre-2008 level. The national debt has more than doubled since 2008. The annual deficit is running at levels that, outside of the immediate pandemic response and the 2008 crisis, have no precedent in peacetime American history, and the political environment in Washington shows absolutely no evidence of the fiscal discipline that would be required to change the trajectory meaningfully. Both parties have demonstrated, in practice, regardless of their stated positions, a consistent willingness to spend beyond revenue and defer the consequences into the future. The future, the data suggests, is arriving. Now, I want to talk about the global dimension of this story because the debt problem is not purely American and the gold story is not purely domestic. The weaponization of the dollar-based financial system that occurred when the United States and its allies froze approximately $300 billion in Russian central bank reserves in 2022 sent a signal that echoed through every finance ministry and central bank in the non-Western world. The signal was this: dollar-denominated assets held in Western financial institutions are not neutral reserves. They are instruments of political leverage that can be neutralized at will by Washington. Any government that finds itself in geopolitical conflict with the United States can have its financial reserves effectively confiscated without a shot being fired. The only major reserve asset immune to that risk is physical gold held within your own sovereign territory. The response to that signal has been documented and unambiguous. Central banks globally purchased gold at the highest rate since 1967 in 2022. They continued at near-record pace in 2023 and through 2024. The People's Bank of China has been adding to its official gold reserves consistently. India, Poland, Singapore, Turkey, and dozens of other nations have been diversifying away from dollar reserves and toward gold at a pace the market has not yet fully priced. This is not speculation about what might happen. This is a trend that is already happening, that is documented in official data, and that represents a structural shift in global reserve management with profound implications for gold demand over the coming years. The BRICS coalition, Brazil, Russia, India, China, South Africa, and the growing list of nations that have joined or expressed interest in joining, has been in active discussion about monetary arrangements that reduce dependence on the dollar as the primary medium of international trade settlement. These discussions have not yet produced a functioning alternative reserve currency, but the direction of travel is unmistakable. The petrodollar arrangement that has anchored global dollar demand since the early 1970s. The system by which oil is priced and settled in dollars, creating permanent structural demand for the currency regardless of U.S. fiscal behavior, is being slowly but deliberately circumvented through bilateral trade agreements settled in yuan, in rubles, in rupees, and in barter arrangements that bypass dollar clearing entirely. Every barrel of oil sold outside the dollar system reduces the structural demand that has allowed the United States to run deficits and expand its money supply, with consequences that are exported to the rest of the world rather than felt immediately at home. As that structural demand erodes, the dollar's purchasing power faces pressure that monetary policy alone cannot fully offset. Gold is the asset that has historically absorbed the purchasing power fleeing a weakening reserve currency. It happened when the pound sterling lost its reserve status after World War II. It happened when the dollar lost its gold backing in 1971. It is the mechanism through which the monetary system rebalances when the dominant currency's credibility comes under genuine structural question. The data does not tell us this rebalancing will happen on a specific date. But the conditions that have preceded every previous instance of this dynamic are more fully assembled right now than at any point since Nixon closed the gold window over 50 years ago. Let me talk about what the data suggests in practical terms, because I think this channel only has value if it connects analysis to something actionable. And as always, I want to be explicit. Nothing I say here is financial advice. Your situation is specific to you. Consult professionals appropriate to your circumstances. What I can provide is the analytical framework. Gold serves a specific function in a portfolio that no other conventional asset class replicates. It is not a growth asset designed to compound earnings over time. It is purchasing power insurance, a hedge against the precise set of conditions that the debt data describes: monetary debasement, currency credibility erosion. The fiscal dominance scenario where the central bank's independence is compromised by the government's borrowing needs. These are not exotic tail risks. They are the baseline trajectory of the current fiscal situation if nothing changes. And nothing, the political data suggests, is going to change in the near term. Physical gold, coins and bars in allocated storage or personal possession eliminates the counterparty risk that runs through every paper instrument. A gold ETF is a claim on gold managed by an institution that can fail, that can be regulated, that can be subject to the same financial system stress that gold is meant to protect against. Physical metal is a thing, not a claim. That distinction matters more in precisely the scenarios where gold matters most. Gold mining equities offer leveraged exposure for investors who want directional participation through traditional markets. When gold prices rise against relatively fixed production costs, the free cash flow of a well-run, low-cost producer improves dramatically. Royalty and streaming companies, which provide upfront capital to miners in exchange for a percentage of future production at fixed low prices, offer a way to access that leverage with reduced operational risk. The trade-off is real in both directions. Mining stocks can dramatically outperform physical gold in a bull market. They can also dramatically underperform in a downturn if operational problems compound with price weakness. The core question the data poses is simple. If the fiscal trajectory of the United States is what the official government numbers say it is, and there is no credible dispute about those numbers, only about what they mean, and if the historical response of monetary policy to an unsustainable debt load is what the 1970s, the 2000s, and the post-2008 period all show it to be, then the question is not whether gold has a role to play in thinking about the next decade of monetary history. The question is whether the people asking that question are asking it early enough for it to matter. The pattern the data describes has played out before. It has played out in different countries, in different eras, under different political systems, with different central bankers at the controls. The specifics change. The monetary arithmetic does not. Governments that borrow beyond their means, that cannot raise taxes or cut spending enough to close the gap, that turn to their central banks to monetize the deficit, those governments have always, without exception, produced environments in which gold repriced sharply relative to the currency being debased. The United States is not immune to that arithmetic. No nation in history has been. I'm Marcus Vail. The debt numbers are public. The historical pattern is documented. The central bank behavior is on record. The gap between what the data shows and what the mainstream financial conversation acknowledges is, in my judgment, one of the most significant information asymmetries available to any investor paying close attention right now. Do your own research. Verify everything I have said against primary sources. And ask yourself honestly whether $36 trillion growing at $3 billion a day with no credible plan for resolution is something that should change how you think about what your money is actually worth.